Well, welcome to our High Rock monthly video. I'm Scott Tomlinson, and with me is my colleague and partner and the founder of High Rock, Paul Tepsich, as well as High Rock's certified financial planning professional, Bianca Tomlinson. As you all know, we have three investment models from which we apportion an allocation percent to each client portfolio based specifically on our goals, the time horizon required to achieve those goals, and our tolerance for the risk and the potential for volatility that may be required in achieving those goals. It is derived from each of our wealth forecasts. So our investing strategies and asset allocations are a function of all of our wealth forecasts. In our regular conversations with our clients, we always stress the longer term outlook for your time horizons. And although we do have to report your portfolio performance through each quarter of the year, we remind you that it is simply a snapshot in time when we look at the quarter or even yearly performance. As most of us have longer than 10-year time horizons ahead of us and our goals to match them, it is important that we focus on those longer term goals rather than the short term swings in portfolio value. And we've seen some pretty wild swings over the last couple of quarters. The good news, of course, is that all of our portfolios have bounced back nicely through the first quarter of 2019 after a very difficult last few months of 2018. And now, depending again on your specific allocations, the level of your portfolio's investments, they are running somewhat at an annualized rate of a growth rate of near 20%. Now, we think this is not likely sustainable, so don't get too excited. In fact, we actually think that we continue to need to be cautious about what is to come, and we'll get to that in a moment. But of course, we do manage risk first, and we focus on the return per unit of risk taken as a very key metric in the management of our portfolios. Paul, any commentary there?
Well, that's number one is risk-adjusted return. So, and as you can see in the top middle part of the page, our actual High Rock client, Scott, we should mention that we always use the same actual High Rock private client. We don't deviate between that client and other clients. But as you can see, they have the best, just marginally, by the way, over the last 5 years, ending March, the best return per unit of risk taken. And again, it's not enough for a client or a prospective client or anybody in this country or anywhere in the world to look at it and just say, oh, I made X return last year or the last 5 years or 10 years. The real question is, what type of risk did you take to make that return, whatever that return might be? And that's exactly what this chart shows. What we want to do, across quarters and the way we've invested our portfolios, the way we've invested them is that we are going to take the least amount of risk possible, which is the standard deviation, to meet our returns. That's it. That's what we're trying to do. That's our number one goal, and that's what this table at the chart shows. That's it, Scott.
Well, and just to add to that, I mean, that's what we want to do in our respective portfolios. And again, it's what we invite our clients when we invite our clients to be part of what we're doing, right?
Exactly.
Okay, so what are we focused on? Well, last month we showed this chart of how central banks in the U.S. and also in Canada have been tightening monetary policy until stock markets fell off the cliff in December. Now, the first quarter economic data has showed significant slowing of GDP growth on a global scale, and that may have pushed the euro area into recession. We won't see that until a little later on in the month. But Canada appears to be not too far behind, despite our finance minister and Bank of Canada governors having somewhat more upbeat assessments. But central banks will never predict recession. However, in the U.S., and as a result of what we're seeing in front of us, 85% of recessions have occurred after Fed tightening. So we like the odds that we're on the right track, believing that a recession is probably not far away. Paul?
Doesn't sound very awe-inspiring. I'm sure most people out there and most other advisors and portfolio management companies like ours probably talk a pretty bullish or positive scenario, probably 99% of them, but we're managing our own money here as well, and we're trying to protect our capital. So if we think, as this chart we're looking at right now on slide 7 shows, that the potential for a recession is becoming very heightened, we're going to protect our capital. We're not going to tell a story that we don't believe exists.
So our theme for this month is divergence. First, let's go through a bit of history. In the early part of the decade, in response to the need for liquidity in financial markets, the U.S. Federal Reserve embarked on a series of quantitative easings that plowed liquidity into financial markets, basically forcing investors into the stock markets as interest rates went to zero. And you can see the impact of the quantitative easing through the first half of the decade and how that impacted stocks. In 2014, the Fed stopped quantitative easing, and the economy and stock prices went sideways until 2016. Now, with the election of Donald Trump and the anticipated and eventual tax cuts that he brought forward, this fiscal easing also was a one-time boost to liquidity and pushed stock prices higher. However, at the same time, the U.S. Federal Reserve started to remove liquidity from the monetary system by reversing quantitative easing, which in fact became quantitative tightening. So stocks obviously were busy celebrating tax cuts and paid very little notice to this until really December of 2018, and the combination of higher interest rates and quantitative tightening and the prospect of a slowing economy were the catalyst for the big sell-off in December. Paul?
Yeah, Scott, we should just add, the way this chart is constructed is the start date is the beginning of January 2009. Both the S&P 500 in orange and the Fed's balance sheet in white start at 100, a level of 100, just FYI if you're looking at the axes.
So what's changed? Well, the U.S. Fed has stated that they will pause from raising interest rates. And the bond market reads this as a warning of a slowing economy, so lower inflation and lower long-term yields as a result. So on this chart, you can see the U.S. 10-year yield has come down significantly. And of course, as bond yields come down, prices go up. At the same time, we've had this divergence where the S&P 500 has continued to go higher. And stock markets are believing that the Fed and other central banks will come to their rescue, will protect them from volatility, as they obviously did talk about pausing any further tightening after the big meltdown in December. And of course, at the same time, you have the White House pushing for lower interest rates because they want to propel the stock market higher, which certainly is part of Donald Trump's re-election plan. So stock prices are up and bond prices are up as the bond yields have fallen. And this is a divergence that historically resolves itself usually with falling stock prices or potentially rising bond yields, or maybe a combination of both. And that's what certainly happened in 2018. So, Paul, any comment on that?
No, I mean, other than to look at the S&P 500 in yellow, and it's quite a V-shaped recovery, but the bond market, which we always say leads all other capital markets, is not buying it. So the risk assets like stock markets have been conditioned the last 10 years to rally on easy monetary policy, and the fact that the Fed over the months of December and January went from continuing their tightening path in mid-December to talking about not raising rates and being very quote-unquote patient. The risk assets have read into that to mean that the Fed has your back and rates will stay low. So let's buy risk assets again because it's worked the last 10 years, as you can see in the chart. But the bond market is telling us there's something more sinister happening with the economy.
And so are corporate earnings, for that matter.
Yeah, an earnings recession.
So the anticipation is that the first quarter earnings are going to be earnings growth lower. All estimates are for earnings growth lower by almost 4%. And forward-looking estimates for the remainder of the year show very little signs of any significant growth. So this becomes our second divergence. We've got rising stock prices and lower earnings growth. So if, as we suggest, economic growth does not pick up considerably, it's going to be harder to justify owning assets that, through their earnings, are supposed to provide some value. Paul?
Well, yeah, just as a slide before, Scott, slide 10, I mean, that's too negative. If true, if first quarter earnings come out negative by roughly 4%, I mean, arguably the fourth quarter was negative from the third quarter. So you've got two consecutive or sequential quarters of negative earnings growth. So from a fundamental perspective, it's not great.
And there's that divergence again. The second divergence is earnings are down to flat, as you can see on the dark blue line, and you still got share prices rising. Now, it was more realistic back in December or early January when share prices were moving down into a more value-oriented situation, but subsequently they've moved back out of what we would consider value territory. So again, another reason for us to be cautious on what's happening with stock prices.
And Scott, we could add on that chart, we did do a little bit of buying on the down trade in November, December last year. We stuck our toe in a couple times and bought a few things. We didn't catch the bottom. And stocks having moved up to where they are, we actually took profits on one of those positions as well.
Yeah, so we have been active. There's no question about it. We will continue to be active when we feel there's value. We'll stick our toes in, but we want to make sure we get value for our hard-earned money. All right, well that's it for this month's webinar video. I know it's been it is tax time. Bianca's been working hard to make sure that everybody gets what they need. If you don't have any of your tax slips or you've accidentally tossed them out, don't hesitate to get in touch with us. We'll provide you with all the information that you need to file your taxes appropriately. Remember that your fees that you pay us in your non-registered accounts are deductible. So that's a pretty important thing to consider going forward. As well, we will have our quarterly reports out to you probably the beginning of next week. So you can look forward to that. And of course, we're always available if anybody has any commentary or wishes to talk to us. So that being said, we wish you all the best for the month of April and look forward to regrouping at the beginning of